From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. This is the HPS Macrocast. I'm Matt McDonald in for Tony Fratto this week. I'm here with, as always, with John Fagan and Brendan Walsh from Markets Policy Partners. It is the 8th Work From Home Friday at HPS. That is April 24th. For those of you still following the Gregorian calendar, we'll talk about the week that was and what we see going forward. Let's start with the latest package passed through the House and Senate. The expectation that Trump is going to sign this today. This has mainly been focused on PPP extension, though there is money for hospitals and virus testing in the package. It is technically the fourth package, though it is not phase 4, for those of you keeping score at home. What we see in this, there's an incremental $310 billion increase for the Paycheck Protection Program. So I guess that total lending, is that up to $660 billion now? Is that the total
about
package?
That. Yeah.
So we see that there's another $75 billion for hospitals. There's $25 billion for virus testing. Brendan, you had a good rant on this last week, but there is something quirky about Congress passing a bill to save the economy and then not funding it properly. I think this is a piece that everybody assumed was going to come, but certainly in the waiting, there was some impatience on the fact that this wasn't funded properly from the outset.
Yeah, and I think Tony has it right, where we shouldn't just keep funding it. It should just be an open-ending funding, and once we've reached the limit, we stop. But to have to every week, because this 30 billion is already accounted for. It's done. Yeah. It's going to take them a week to lend, and then we're going to have to do it all over again next week. We're going to need at least $1 trillion if we want to achieve what we're trying to achieve.
Yeah, I personally find the exercise quite frustrating. You have this element now of, companies getting criticized for taking the money that's designed to save the economy. You have people complaining about the speed at which it's going out or complaining about who it's going to. The banks themselves have regulations on, there's know your customer, there's anti-money laundering this is not and if the money is going out, if you sped it up and the money goes to the wrong places, they're going to get attacked for that. I just don't. The only
it's also a little funky because
is squarely on Congress for not funding it properly.
Yeah, and also especially for the smaller businesses, like a hair salon, things like that. The fact that it's a payroll protection plan, you're supposed to hire back your people, but because we've enhanced the unemployment benefits,
yes,
a lot of employees are very upset when they get hired back because now they're making less money.
Yeah.
So it was well intended, but the execution of it has not been ideal.
Even under the perfect circumstances, there were always going to be a broad swath of small businesses that never got this money. It's just,
right.
Even if you put $1 trillion into the hopper and just the way it worked, the estimates that we talked about were that the first infusion would get up about 3 million small business loans, and it ended up being 1 million. And so that speaks to larger loan sizes, but it speaks to a larger body of small businesses and single sole proprietorships that aren't going to get the money. And that's just the reality. Not everybody's going to get it. It's a situation in which, it's hard to fault the banks for, going to their biggest clients and the ones they have relationships with first. They weren't told to do otherwise. This bill, as I understand it, has some, it's trying to redirect some of that money into smaller banks. I think,
they have made adjustments.
My pencil on this. Yeah, there was 30 billion of it is specifically earmarked for smaller banks and credit unions, and then another 30 billion for even smaller lending operations. specifically designed to try to reach these echelons of small businesses that hadn't been touched by the first set. Is that accurate, Matt?
Yeah, I believe so. There are set asides within the program. It's also, I mean, the other piece of this that strikes me is that just from a business operations perspective is that, look, the smaller you are, the less sophisticated your kind of financial operations are, the weaker do you have a line of credit? Like, who knows? And that's something where even if you do have a, checking relationship with a bank or something like that, is that it's probably going to take those small businesses more time to get their stuff together to do the application and all the rest of it. I mean, at the end of the day, I've candidly been impressed with how quickly the money has gone out the door.
Totally agree.
Considered. It's just inexcusable that it wasn't funded. I mean, that is crazy to me.
Right. And the problem too with the small businesses is a lot of small businesses are banked at one of the big four, Bank of America. And so Bank of America, I have a friend there, they send out emails asking for volunteers, not loan officers, just anybody that's kind of senior on the weekend to read loan documents. So they're trying their best. They just have a ton of clients to get to. So while directing the money towards the smaller banks and communities is a good idea, the problem wasn't that those banks weren't trying to make the loans. They just didn't have the customers. So that small business guy has to take his banking relationship from Bank of America and try to find a small business. I mean, a small bank or a credit union, which is not that easy to do.
Yeah. One of the other things that we've gotten in terms of feedback, I've been talking with an old friend who is who's close to this issue up in my home state of Massachusetts, and one of the things that this was actually something that Tony mentioned right off the bat when this program was first beginning to be put into place in the first CARES Act, was that the structure of this as a loan is, it's obviously designed to be forgiven. It's intended to be forgiven.
Yes.
And the fact that you've structured it as a loan is to try to, incentivize the kinds of behaviors, keeping people on the payroll and so forth. The issue is small business owners don't have clarity as to whether they're going to be able to meet those criteria because they don't know how long they're going to be shut down. Right now it's June 30th. And so a lot of them,
it's a great point.
Yeah. If you're a small business owner and you're ready to skate the system and you're not a high integrity operator, you can take the money and run. But that's not how most people operate. These small business operators are very, very sensitive to taking on debt, and they want to be able to, they need to be able to know that they pay it back if necessary, and they don't want to try to cheat the system or game the system in some kind of way. And so she's been getting a lot of questions on that particular issue.
Yeah, this is a great point and something that I want to focus in on a little bit, because it's funny watching all this. When the program was first announced, you saw a little bit from the banks of saying, because the kind of qualifications and the underwriting, quote unquote, is super loose on these loans. And originally the administration was saying to the banks, hey, you need to certify and make sure that this is being done for the right purposes. And the banks were like, whoa. Like, we're not going to apply loose standards that you're imposing on us and then be liable for that on the back end. I mean, they went through this in the financial crisis where the government told them to acquire companies and then said, oh, you're liable for everything that they did. So, once burnt, twice shy. They were very cautious at the front end on signing up for this, and the administration backed off on some of those things. But now you're seeing the exact same behavior from policymakers on the back end, is that they set up these programs, they set the qualifications, and then institutions that qualify them take the money, and then they get berated for taking the money. I mean, this is the part of the policy response where you start to see the scrutiny ramp up, and people get mad, and politicians take advantage of kind of public sentiment on this stuff. And it's outrageous, because if you don't want Harvard taking the money, just write them out of the policy at the front end. Don't make them eligible, but then attack them for for qualifying
Yeah.
and doing the thing.
And also, go ahead, Jeff.
Yeah, well, I mean, what they're calling the shake, one of the things they're calling the Shake Shack exemption, the one that, you know, is for, I mean, each franchise does operate like a small business. That's fair. But when you look at the, you know, overarching company, big, huge publicly traded company, it doesn't apply. The Shake Shack exemption isn't a one size fits all kind of formulation, because some of the ones that have gotten swept up in that controversy are much smaller. But it's, as you say, they were following the rules. But on the other hand, they probably should have known. They probably should have known that this was a calculated risk on their part. Yeah, it's probably worth trying to take the money, but you know, they were probably prepared and not entirely surprised when they got a little bit of blowback, and they could just, you know, I'll give it right back.
But I think this is all interesting when we compare the PPP program, which really was intended to you don't have to pay these back. That's the goal. Where now the Fed is launching the Main Street lending program, which that is the Fed making investment. They have to get paid back by mandate. So they're having, from everything I'm hearing, a kind of a difficult time rolling that one out. It's a little more complicated, where you actually have to do underwriting and investment kind of analysis.
Yeah, I think that, I mean, it's interesting to watch this, because there's been a little bit, but there will be critiques down the road of, oh, why did we let the banks do this and make money on this program? We should have just done it through the government. And this is kind of real-time example of like, it's not as easy as it looks.
Yeah, well, because the Treasury doesn't have a bank.
It fast.
Yeah, we don't have a bunch of underwriters sitting around, you know, like in a basement that is ready to launch out.
And we're obviously there's a learning curve that policymakers are on here and trying to like build this plane in flight. But as right up until now, the partisan wrangling hasn't really been all that forceful. But that is going to change, it seems, in the next iterations of these, in the next phases of these bills. And particularly the battle lines are being drawn over the money to the states. And we've obviously seen Speaker Pelosi and Senate Leader McConnell, set their, establish their positions on this issue. And
Matt, HPS being a data-driven shop, I thought Governor Cuomo had some powerful statistics for Senator McConnell last night, where Kentucky, basically 40% of their state budget comes from federal funds. They receive 140 billion, where New York sends out 160 billion.
Well, we're seeing, I mean, I think that's that piece, and what we're seeing with some of the PPP stuff is that the initial like severity and the unity that resulted in, that's going to dissipate a little bit more and more and more over time, as people are going to have different perspectives on who should and shouldn't be getting funds. We've talked to a lot of clients about the states getting bailed out, and I think in the end they're going to need to, and we're going to get there, but it's going to be a real bumpy ride, and it's not happening anytime soon. Yeah, there's been times in the past where different cities or states, I mean, cities especially, when they've gotten bailed out, there's always strings attached. I mean, there's always strings attached. Let's take a break and come back. This is the HPS Macrocast.
You've heard of the HPS Macrocast, but have you listened to HPS Insights yet? Check out the HPS Insights podcast, including episodes about remote TV appearances, privacy and the role of big tech, the State of the Union, impeachment, and more on your favorite streaming platform or at hamiltonplacestrategies.com/podcast.
All right, welcome back to the HPS Macrocast. I'm Matt McDonald with John Fagan and Brendan Walsh. Tony Fratto is away this week, and while the cat's away, I have a game for us to play. So we're gonna play bottom or not bottom. So I'm gonna go through a couple of different market measures, and I want to hear from you guys whether you think we're at the bottom or not bottom. And for some of these, I think it'll get a little quirky, because the bottom is not always zero, as we are seeing. All right, so So let's start out broad. So S&P 500, bottom or not bottom?
I'm going not bottom, Matt. It's not a popular view. The S&P 500 been pretty buoyant over the last couple of weeks. Although this week we're having a little bit of a downer on the back of oil. But the questions we've been getting from clients is really, how are equities going up? How are U.S. equities going up when news is so bad? We talked a little bit about that in the last couple of sessions, and this earnings season has really underlined one specific facet of it, which is this pandemic is creating serious bifurcation in the market. Winners and losers very clearly demarcated, and there are some companies that are absolutely, this is right in their wheelhouse. Amazon, Netflix. I mean, how much extra screen time I've given my kids. We're looking for other streaming services. We've run through everything we want to see. I mean, it's like right in their wheelhouse. And then, of course, you've got the airlines, and their stocks are down like 70%, and they, aren't bouncing back anytime necessarily real soon. I think the, that dynamic can kind of hold the market up to some extent, but I'm worried. There's low certainty on all aspects of this, but I'm worried about a longer tail than is being priced into the equity market right now. The equity market, when you look at it, looks a little bit out on a limb. If you're looking at oil, my gosh, I mean, that is discounting a long, dark slog through an economic trough. Same thing with the treasury markets, global commodities generally. The S&P 500 is way out ahead of its peer group. You look at Asia, China, where they've done great recovery, and take that with a grain of salt, but their equity market isn't doing anything.
Brendan, S&P 500, bottom or not bottom?
Not bottom. John and I are part of a group called the COVID Alliance. So we've, not just John and I, there's 80 people involved in that, amazing people. So in a month, we've built a tracking app, like in South Korea, and we partnered with Google and Apple, and we're launching it right now. But
Brendan and I are the least amazing people.
We're a little more on the policy side and a little less on. When they're doing all-night hackathons, we're asleep. But just seeing how difficult it has been to do that and roll it out, I just think the people are just too optimistic about the reopening of the economy. It's going to take a lot longer, and it's going to be a lot more difficult than we think.
I agree, not bottom. This has been a weirder onset to a recession than any that I can recall, but I think that we're getting into the place where I also think that the mental models that people are applying, I just think that it's not necessarily that the economy can't come back, it's that we can't allow it to come back as fast as I think people thought initially. I think that the thing that I've been thinking about lately is that this kind of reminds me, the public health professionals, this is like their equivalent of the financial crisis was for economists, is that post-financial crisis, like the economic policy answers were just weak, and people didn't really have a lot of solutions, and they didn't know as much, even in the crisis, they didn't know as much as about what was going on as we needed to know. And I think it's the same thing for the health side right now. All right. Next subject, interest rates, bottom or not bottom?
The Fed has, they rushed to the zero lower bound here, and Fed officials have come out and said that negative interest rates are not for the U.S. They may be okay overseas, and we have had negative interest rates for a long time in Europe, negative interest rates in Japan, and that it's, and the Fed can obviously say that, but should you take them at face value? Mm-hmm. I think we should. I think it's very difficult to look at the experiences of negative interest rates in the EU and Japan and say, ooh, I want that. It's very difficult for the banks. Think of what it would do to the money market funds. And plus, we're the reserve currency. We just have a different, you can maybe get away with that with other currencies, but not with the global reserve currency. I think that interest rates have bottomed.
Brendan?
Yeah, I agree. Costa Rica just literally 5 minutes ago put out a piece on Bloomberg saying that they should take rates negative, but that's just so far, in terms of where the core of the Fed is, we're not there yet. So I think we're bottom. And most importantly, to John's point, the dollar and U.S. rates are different because we're the reserve currency.
I agree. All right, good segue to dollar. The dollar, bottom or not bottom?
Well, we can kind of flip this on its head, and the dollar top or not top.
Yeah, right.
I think the dollar actually has. I think it's going to stay strong. I don't think we've got a huge leg higher. So I'm going to say top. I think the Fed gets out there in front of it if they absolutely need to. Every global central bank is playing the same game. So nobody wants their currency to get stronger. So you're not going to see the dollar weaken that much because everybody's sort of all the central banks are sort of keying off each other. But I think the Fed and the administration will head off another big dollar spike. It's just not acceptable.
Yeah, and if you pull up a chart of the dollar, we're at the extreme levels. So sure, it could weaken or strengthen a little bit, if you're trying to trade it on a daily basis. But in terms of the effect it's going to have on the economy and businesses, I think we are where we are for the foreseeable future.
Just for the record, this is my hardest call. I have the least confidence in this call.
Yeah,
because we have $5 trillion just got put in the
I'm going to say we're not there yet, in part because I don't know. I don't feel like and to your point is that who knows how the Fed responds to pressure, but we haven't, in my mind, part of what I'm thinking about is that we haven't really, to date, this has largely been a advanced economy or more developed economy problem. And as it moves into the developing world, I just saw a piece on Argentina and chase for dollars there and some of the stuff that's going on. And I just think that there's the second act as it moves to the developing world could result in a second race to safety on some things. So I feel like there's still more to be written on that. All right, last one. This is a fun one. Oil. Bottom or not bottom? How low can you go?
I think for for West Texas Intermediate, the U.S. benchmark, I think I feel pretty confident in saying that negative $40.32 a barrel for the expiring May contract is probably the bottom for that one. That happened earlier this week and was a headline grabbing and kind of coffee spitting moment for a lot of people. It's the idea of you have to pay someone to take your oil. That's what it was saying, and really this was kind of a market anomaly. So we can talk a little bit about that. But oil prices are that's the bottom in oil prices. They've since rebounded. They're in the 20s. I think that's probably I don't think we get much past the bottom that we've seen. We went down into the teens earlier this week.
I think for the futures contract, it's not the bottom, because the reason that it went to negative 40 was because there's nowhere to store it. So we're going to have the same problem next month, and there's less storage.
Right.
So I think every month when the futures contract expired, we're going to go fairly deeply negative because no one wants to take it for delivery.
Yeah.
Unless the government just buys it all.
It's interesting because this doesn't
have enough storage to do it either.
This isn't necessarily a financial problem as much as it is a physical problem.
It's a physical problem, yeah.
I assume that this is a problem that people have been working to solve over time. It's a little bit like the dollar question is, what does the response look like? But boy, I don't see the uptake for demand on the near-term horizon. So who knows?
And one futures contract is 10,000 barrels, but it's not like you can just buy. They don't give it in barrels. You have to show up with your own thing. So it's not like we can all put together our money and each take a barrel and put it in our garage for 2 years from now.
Yeah, the solution just doesn't jump out at you. This question about storage really was crystallized with the IEA report. It was the IEA report which sort of kicked this off last week, when oil prices had rallied off like a 2-decade low as OPEC and Saudi and Russia buried the oil price war hatchet, and OPEC Plus got together and cut
Right.
you know, cut some pretty significant amounts of output, 10 million barrels a day through the next 2 months, which is not, it's a major event. But then when IEA came out and said storage capacity might be exhausted by summer, that was a real, you know, that crystallized a lot of risk factors. And you know, now we're seeing a situation in which the, you know, policymakers are obviously scrambling to try to figure this out. The Texas regulators, you know, Texas, it's a thorny conundrum. It's very costly to shut down production. They've deferred the decision until May 4th. Texas isn't known for this kind of thing. You know, there was talk about Texas teaming up with the oil sands folks in Canada to come up with a production cut possibilities. The Canadian government is supporting their oil industry. We've had a hard time getting that. That was supposed to be into there was money to fill up the Strategic Petroleum Reserve, the U.S. Strategic Petroleum Reserve in the first CARES Act, but it got deleted. And it's just going to be a really tough sell to get it through the Democrats in the House to dump bailout money into the shale patch.
Yeah. All right. Thank you for playing. Let's take a break, and we'll come back and look at the week ahead. This is the HPS Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS Civic Science Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through hamiltonplacestrategies.com.
All right, we're back. Brendan, take us through the week ahead. What do we have to look forward to?
So, you know, data matters, but it doesn't necessarily matter. So we get first quarter GDP for both the US and Europe. And it's expected to be bad, but it really doesn't capture the full reality because January and February are still pretty normal in terms of being open. We also get personal income and spending in the United States, but that's for March. And again, you know, half the country was still kind of normal then. It will be slightly interested within that same report, we get the PCE price index. So while inflation doesn't matter for policymakers currently, you know, we will be able to find how deflationary shutting the entire world is in these next few months. And that kind of leads into probably the most important events of the week, which we have the Federal Reserve has their regularly scheduled interest rate meeting, and also the Bank of Japan. Both of them have done extraordinary measures in between meetings. 2 weeks ago, the Fed announced $2.1 trillion in new programs, like the Main Street lending program we're talking about. So while no one's expecting the Fed to do anything on the interest rate side, we will get more clarity on how these programs are doing and how they're implemented. And the Bank of Japan also similarly. It looks like there was rumors out yesterday, not rumors, there was leaks from the Bank of Japan to that they're looking to discuss unlimited bond buying, and also so they want to take away the limit so that they can buy unlimited amounts of bonds in the future. But at this meeting, they're looking to probably double their purchases of corporate bonds.
The earnings season, I'm fascinated by. I'm very curious to go through earnings call transcripts and see what's on CEOs' minds as they look at the landscape. And John, to your point earlier on the different impact between different types of companies and how they're positioned for this stuff. I mean, that is just going to be fascinating to get a window into what's going on in some of these places.
Yeah, and next week we really get some household names coming out with first quarter earnings. Amazon, Apple, Facebook, Google, Microsoft, Boeing, 3M, Ford, McDonald's. List goes on, and it's the real heavy hitters week of earnings season.
It's funny as we I mean, GDP is going to be the first estimate of the first quarter, which is in the, you know, we've talked about a little bit about this in the past, but the speed of economic statistics really just aren't built for this moment. So you do have a time where the qualitative becomes more valuable. Just what CEOs are seeing and what they're thinking in terms of the earnings data is probably of more interest to me than the actual GDP number.
Right. And kind of similar when we were talking about if the S&P has bottomed or not. The S&P is not really a great indicator for the health of the economy or companies, because usually in recession, we go into recession and everyone's kind of hurt, and then we build it out. This isn't a recession. This is a global pandemic where we're locked in our house. So there's been some monstrous winners. Zoom went from 1 million users a day to 300 million. Yeah. Amazon is at all-time highs because it's the only way we can buy food. Whereas Ford, not doing well. No one's buying cars. Any restaurants, you're not allowed to go to. So it's just totally bifurcated. So you really have to go company by company rather than looking at indices as a whole.
Well, and look, as you're thinking about valuations going forward, is that when do you think it's going to end, and how much of this do you think is going to be permanent? How much, what aspects of this are going to result in permanent behaviors versus stuff that is a temporary blip that people hate? I think everybody's going to be ready to go out and have a nice dinner at a restaurant, but there's definitely going to be aspects of this. We see it in our own business of like flexibility around remote working or something, is that everybody's had to adapt and really change their behaviors. And some of those are going to be sticky over time. Yeah.
The one thing that I read the other day, and I should have realized it, but everyone said this is different, everything like that. Well, during the Spanish flu, it was 17 and 18, and then the Roaring 20s happened. So I'm hoping that the rest of the decade is going to be a huge party.
All right, that is a great spot to end it. Thanks everyone for listening to the HPS Macrocast. I'm Matt McDonald with Hamilton Place Strategies. Thanks to John Fagan and Brendan Walsh of Markets Policy Partners. We will see you next week.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.